Do you think trading is just a game of charts and strategies? Think again, because the real game is all about your mind and discipline. The art of trading reveals that surviving in the market isn't just about technical skills, but about mental balance, patience, and self-control. This book presents trading as an art form, where every move, every decision matters. In this video, we're going to explore how a trader can master their mindset, emotions, and decision-making to achieve long-term success in the market. So if you want to bring not just money, but also a mature perspective to your trading, make sure to watch this video until the very end. Chapter 1, Part 1. Trading isn't gambling. It's an art that can be learned with wisdom, discipline, and the right knowledge. This line is the first and most crucial truth of your trading career. If you think making money in the market is just about luck, you're missing out on a huge opportunity. In reality, trading is a science, deeply intertwined with rules, patterns, and psychology. Understanding and learning, this is essential for every new trader. Trading begins with understanding the market. Millions of transactions happen every day, and hidden behind them are the trends and signals that a successful trader can spot. These signals tell you when to buy, when to sell, and when to take a break. First and foremost, you have to understand that the market is always right. It doesn't depend on your desires, hopes, or fears. It has its own behavior, which is the result of the emotions of millions of investors. Therefore, the trader who can detach themselves from emotions is the one who wins. You might be wondering how to detach yourself from emotions. For that, self-mental preparation is most important. Trading is a mental game. Just like your fitness is important in cricket or football, your mental state is crucial in trading. Fear, greed, and haste are three enemies that cloud your judgment. Once you learn the basic language of the market like support, resistance, trends, volume, and patterns, you need to start trusting yourself. Not every pattern or signal in the market is 100% accurate. The real art is knowing when to trust it and when not to. To succeed in trading, the most important thing is a solid plan. Trading without a plan is like going into a jungle without a map. Your plan will tell you when you'll enter, when you'll exit, and how much risk you're willing to take. It will also determine when you'll stop if you incur a loss. In India, many people see trading as just a quick way to make money. But those who want long-term success need to delve deeper into the market. Some market rules are universal, but in emerging markets like India, specific strategies need to be adopted, such as considering the local economy, government policies, and the impact of foreign investment. From a marketing perspective, trading is a business where your biggest customer is yourself. If you learn to understand your own mind, your trading decisions will be made more wisely. This is only possible if you control your emotions and develop psychological understanding alongside technical knowledge. Successful traders continuously update their knowledge. The market environment, rules, and technology keep changing. If you stay stagnant and stop learning, the market will leave you behind. Therefore, a trader's greatest strength is their eagerness to learn and their patience. What truly sets you apart in trading is your risk management. No matter how good your analysis is, there's always uncertainty in the market. Therefore, it's essential to manage risk with every trade. It's crucial to know how much loss you can tolerate in a trade and not exceed that. The next thing is adhering to your trading plan. Sometimes, traders make a plan and then abandon it. But successful traders in the market strictly follow their rules, even if the market fluctuates. It's difficult to succeed in trading without discipline. To understand trading, you need to know about various market tools and techniques, such as chart analysis, indicators, and trading signals. These give you clues about which direction the market might go. However, every tool has its limitations, so it's important to maintain a balanced perspective. Especially in India, for retail investors, it's important to trade wisely and not rely on any tips or rumors. Making decisions out of fear or greed during market rallies or downturns can lead to heavy losses. Nothing surpasses psychological stability in trading. If you understand your own mood and emotions, you can avoid emotional decisions. Therefore, trading is a profession where self-knowledge and control are paramount. It's also important to know that not every trade will be successful. Learning from losses and not rushing things makes for a better trader. Patience is the greatest asset in the market. The biggest advantage in trading is that it leads you towards financial freedom. If you adopt the right knowledge, discipline, and strategy, your success in the market is certain. But this requires continuous practice, correct decisions, and mental fortitude. From a marketing perspective, by learning the art of trading, you can make your financial life stable and secure. It's not magic, but a systematic process that requires continuous improvement and learning. Chapter 1, Part 2. In the world of trading, the first rule is that nothing is more important than education. Stepping into the market without proper knowledge is as dangerous as riding a motorcycle without a helmet. You need to deeply understand market rules, tools, and strategies. It's often seen that new traders hear about someone making a lot of money and then try to copy them. But remember, everyone's situation is different. Your success depends on your own understanding, experience, and discipline. The faster you learn in trading, the sooner you'll avoid losses. Mistakes will happen, but it's crucial to learn from them. Every loss in the market makes you a better trader, provided you learn the right lesson from it. In simple terms, trading means making the right decisions at the right time. This is based on market analysis. There are two types: fundamental analysis and technical analysis. Fundamental analysis looks at the economic aspects of a company, country, or economy. Technical analysis studies charts and data to predict future market movements. In a country like India, where the economy is rapidly changing, an understanding of fundamental analysis becomes even more important because government policies, economic reforms, and the impact of global markets directly affect your investments. For trading, calm your mind. Are market conditions in favor of my stock? Does news or sentiment support this movement? Is the risk to reward ratio appropriate for my entry? If the answer to 4 of these questions is yes, then trade. Otherwise, don't. This system will make you an expert in timing. Now, let's talk about backtesting and practice. If you want to play well in cricket, you'll do net practice. Similarly, in trading, you need to do paper trading. That means, without investing real money, look at charts and do virtual trades. See if your decisions are proving correct or not. This habit will teach your mind how to spot and understand signals. There's another way to strengthen your timing: understanding a stock's personality. Not every stock behaves the same way. For example, Reliance is a stable stock with big moves, while Tata Motors is volatile. Sudden spikes or drops are common in small cap stocks. So, understand each stock's movement and adjust your timing accordingly. Now, let's discuss a less understood but extremely important aspect: intraday timing. If you're an intraday trader, it's crucial to know that the first 15 to 30 minutes after the market opens in India are the most volatile. During this time, big players change their positions and the crowd is confused. So, for the first 15 minutes, just watch, then make your decision. Generally, 10:15 a.m. to 11:30 a.m. is a good time to take a trade because the market's mood has usually become clearer by then. Similarly, the time after lunch, from 2 p.m. to 3 p.m., is useful for final moves. Position sizing plays another big role in timing, meaning how much money you invest at once. You should only put in a large amount when the timing is clear and the signals are strong. If the situation is unclear, it's wise to start with a smaller size. One more thing Indian traders need to understand quickly is to avoid overtrading. If you're trading 4 to 5 times a day, your focus isn't on timing. It's just on action. And more action means more mistakes. So before you take a trade, ask yourself, does this trade meet my rules? Is it smart to enter now, or should I wait? Every time you do this, you learn to communicate better with time. Now the question comes up, can the success rate be 100%? No system is 100% accurate, but technical analysis gives you a framework to make decisions based on probabilities, not emotions. This is why every successful trader in India, like Rakesh Jhunjhunwala or Vijay Kedia, keeps a trading journal where they record every entry and exit. You should also write in your diary, why did I take this entry, on what basis, and what was the result? This habit will improve your timing day by day. Finally, the most important thing. Timing requires patience, and patience requires discipline. This is a skill that develops slowly, but once it does, it puts you in the category of those 10% of traders who make profits year after year. Remember, making money in trading isn't just about a good strategy. It's about executing that strategy at the right time. And that's only possible when you control your mental state, carefully read market signals, and patiently wait for the right opportunity. Chapter 5, Part 1. Every successful trader has a special quality. They see the market not as a battlefield, but as a flowing river. They know that when you flow with the river's current, you reach the shore more smoothly and safely. But if you swim against the current, you get tired and can even drown. The same principle applies in trading. Understanding the market's direction and moving with it, that's the science of trend following. And in this chapter, we'll talk about that in detail. Many new traders look at trading like this. It's going down, let's buy, it'll go up soon. There's an upward direction, an uptrend, a downward direction, a downtrend, or sideways low, meaning no clear direction. In an uptrend, each new high is above the previous high, and each low is also above the previous low. In a downtrend, each new low is below the previous low, and the highs also move lower. And when neither of these happens, meaning highs and lows both move within a limited range, that's sideways. Most traders lose the most money in sideways markets because they think they're catching a trend, but in reality, they're mistaken. So, the first rule is, don't make any big decisions without trend confirmation. Now the question is, how do you confirm a trend? For this, two of the most popular and reliable tools are moving averages and trend lines. If the price consistently stays above a moving average and the moving average is sloping upwards, it indicates a potential uptrend. If the price is moving downwards and the moving average is also sloping downwards, it indicates a downtrend. Many experienced Indian traders like Rakesh Jhunjhunwala or Vijay Kedia use this method. They identified the trend, entered it, and then stayed in for a long time. They gave the market time, and in return, the market rewarded them. But the average person says, I don't have that much time, I want money quickly. This very thought prevents people from following the trend. Another interesting way to understand a trend is sector analysis. Sometimes, an entire sector trends in the market. For example, if the banking sector is booming, SBI, ICICI, and Axis will all move together. If the auto sector is emerging, Maruti, Tata Motors, and Hero MotoCorp will all gain momentum. So you shouldn't just look at individual stocks, but at the movement of the entire sector. Similarly, sometimes the trend isn't just in the Nifty or Sensex, but in the mid-cap or small-cap indices. So you need to be vigilant about where the real movement is happening. Now let's talk about a common mistake, trying to catch trend reversals. Many new traders try to trade in the opposite direction before the trend ends, meaning they try to catch the top or bottom. The best approach for you is, a trend is a trend until it breaks. That is, when the trend breaks, that's when you trade, and when the trend breaks, that's when you exit. And the ultimate mantra is, market will always test your patience before giving profit. If you don't show patience, the market will only give you false signals. But if you understand the trend over time and mentally stay with it, that very trade will give you the most returns. So next time a stock is moving up or down, don't ask it, where are you going now? Instead, ask yourself, are you giving me the signals I can trust? And if the answer is yes, then go with it. Because that's the true art of trading, flowing with the current, entering at the right time, and patiently staying in. Chapter 5, Part 2. Your biggest enemy isn't the market, nor is it another trader. Your biggest enemy is the person you see in the mirror every morning. In the world of trading, emotions are a double-edged sword. On one hand, they alert you, but on the other, they can mislead you. And if you don't control your emotions, even the best strategy can fail. This is where mental rehearsal comes in. Every professional athlete, pilot, or soldier mentally prepares themselves for difficult situations through practice. A trader should do the same. Every morning before the market opens, ask yourself, what will I do if my trade goes in the opposite direction today? If my stop loss hits, will I be able to stay calm? If some strange news comes out in the market, will I get carried away by emotions? Through this mental preparation, you start to control your internal reactions. And this is what separates you from the 90% who merely react. Now, let's talk about an aspect most people overlook, the trading journal. Every professional trader has a journal where they record every trade. Which stock was it? Why did I buy it? When did I buy it? How much did I buy? When and why did I exit? How was I feeling? Did it go according to plan or not? What did I learn? This journal becomes your mirror, allowing you to catch your mistakes, understand your behavioral patterns, and gradually improve yourself. Now let's talk about the most dangerous emotion, overconfidence. 2 or 3 successful trades, and a trader starts thinking they've understood the market. This is where the downfall begins, because overconfidence forces you to increase risk, tempts you to break rules, and convinces you that you can't make mistakes now. That's why humility is the greatest virtue in trading. A good trader always believes that they can be wrong at any time. They never fight the market, they only read it. And when the signals change, they immediately adapt themselves, without ego, without hesitation. Another important point is taking breaks. Constantly trading, staring at the screen, and reacting to every movement increases mental fatigue. And when the mind is tired, decisions are weak. So a good trader understands that sometimes the best trade is no trade. This self-control will sustain you in the long run. Now consider this. Have you ever adopted a reward system? Meaning, when you execute a perfect trade according to your plan, whether it results in profit or loss, reward yourself. Because this sends a signal to your brain, you're doing it right, following the plan is good. Through this positive reinforcement, you can improve your habits. Finally, I want to share a thought. A trader's job is to predict, but this test isn't about your knowledge, it's about your character. And if you can look within yourself every day, understand your emotions, and trade by balancing them, believe me, your growth won't just be financial, it will be mental and spiritual too. If you had to answer one question, why do you trade? Your answer shouldn't just reveal a strategy, but also a sentiment. Many people trade because they think they can make quick money, but those who last long and make money consistently never trade with emotions, but with a system. Every trader needs a system that keeps them disciplined daily, a system that limits emotions and gives space to logic. But the question often arises, what does systematic trading mean? It means you approach every trade through a process, not based on whether you feel good or bad that day. In systematic trading, the decision-making process is predefined. Which indicators you trust, which setups you believe in, and which conditions trigger your entry and exit. All of this is part of the system. A big advantage of systematic trading is that it gives you stability in instability. When the market is uncertain and every news channel is screaming crash, a systematic trader still does what the system says, no more, no less. This is why the world's most successful traders, whether Mark Minervini or Ray Dalio, all have a clear, tested system. Now let's talk about what a basic but effective trading system should include. First, trade setup. You need to decide which signals you'll trade on. Do you look at moving average crossovers? Do you focus on volume breakouts? Are RSI or MACD important to you? A good system clearly defines when you'll be interested and when you'll ignore. Second, entry rules. As soon as a setup appears, do you immediately jump into the trade? Or do you wait for confirmation? Many professionals adopt a confirmation strategy, meaning after one signal appears, they wait for a second signal or candle. This helps avoid false breakouts. Third, stop loss and position sizing. A systematic trader knows beforehand how much money they can lose in a trade. They don't risk more than 1 to 2% in a single trade. If the trade fails, the loss is contained. Fourth, profit-taking rules. Just as you define your entry and exit points for losses, a system also determines under what circumstances you'll take profits. Do you use a trailing stop? Do you exit at a specific technical level? Fifth, review and optimization. No system is perfect. Every month, or after every 20 to 30 trades, a systematic trader reviews all their trades. How many trades were successful? Where did things go wrong? Should anything be improved in the setup? Has the market's movement changed? This process keeps the system alive. It gets updated over time. Now the question is building a system that easy? Honestly, no, because building a system isn't hard. Trusting the system is. Sometimes the system says don't buy, but your mind says buy this time, it'll feel good. Sometimes the system says sell now, but an inner voice says let's wait a little longer, more profit will come. This is the real test. Can you act like a machine that doesn't deviate from its rules? A good system is one that has been backtested, meaning you've tested it on past years of data. Backtesting provides two things. 1, an estimate of the system's success rate. 2, it builds confidence. When you know your system has been right 60% of the time over the past 5 years, and the average gain is 3 times the average loss, then you have a strong belief in it. Remember, a system is made for the long term, not for every single moment. Therefore, simplicity is key in a system. 5 to 6 simple rules that you can apply without thinking. Any overly complex system can fail in the long run. There's no need to react to every price fluctuation. This is no action discipline law, which is also a skill. And this skill separates you from the 95% who get caught in impulsive decisions. One more thing, systematic trading doesn't mean you'll never make changes. The market changes, and you'll need to evolve your system by testing it accordingly. But even those changes should come through a process, not impulsive decisions. You should run your trading system for at least 50 trades. Chapter 6, Part 2. This seems to be a continuation of a previous section, likely about mental challenges. Chapter 7. This also seems to be a continuation. Your mind starts to challenge you. For example, your system says that if a stock breaks the 20-day moving average and volume increases, then buy. But on the day such a setup appears, some negative news comes out, or the market starts to fall a little, and your mind gets scared, should I really buy? Or, when the system hits a stop loss, your mind says, let's wait a little longer, maybe it'll go back up. This is where the real test is. It's not difficult to follow a system. It's difficult to follow it consistently, because the human mind is never static. It constantly makes new estimates, gets scared, gets excited, and thinks it's smarter. Therefore, the most important thing in systematic trading is self-awareness. You have to understand the workings of your own mind. Every time your mind says break the rule this time, you need to recognize that voice and calm it. Now, another important point, acceptance of loss. If your system has a 60% win rate, it means it will fail 4 out of 10 times, and you have to accept this failure. Accepting this failure can be difficult sometimes, because our inner ego says, I can't be wrong. You need to make your humility bigger than your ego so that when the market scares you, tempts you, or misleads you, you only do what you've already decided. Now, let's talk about another behavioral cycle, revenge trading. Sometimes, when a trade results in a loss, the trader hastily takes the next trade to recover the previous one. But this next trade is often taken hastily outside the system and only magnifies the loss. This is called the emotional loop of losses. There's only one way to avoid this cycle: pause. After every loss, a systematic trader stops for a moment. They review their process. They know that losses are part of trading, and if they followed the system correctly, they should have no regrets. Now the question is, should you ever break the system? Many times, experienced traders tell themselves, this time my experience says this trade will work, and they trade outside the system. Sometimes that trade succeeds. And then the most dangerous thing is that successful traders constantly remind themselves, a system isn't for a single trade. It's for the entire trading career. If you base every decision on experience and not on data, you're trading purely on luck. And luck isn't trustworthy. Now, in a few words, let's understand the mindset a systematic trader needs to adopt every day. 1. Detachment. You need to be emotionally detached from every single trade. No trade is a matter of my honor. 2. Consistency. Make the same decisions in every situation as you've defined in your system, even if your mind says something else. 3. Acceptance. Accept losses and move forward with learning. Now, let's talk about a big mistake: system hopping. Many new traders adopt a system, abandon it after a few losses, and look for a new system. Then the same process repeats a few weeks later. The result is that they never master any system. Remember, no system is perfect in the short term, but if it's profitable in the long term, sticking with it is the real art. You have to build a relationship with your system, where you understand it, recognize its limitations, and still trust it. This is called disciplined trust. Now, another important point, a routine with the system. Every successful trader has a routine. When to open the screen in the morning, which alerts to pay attention to during the day, how often to check trades, and how to review the day's data at night. All these things increase your system's reliability. And finally, if you view trading as a profession, the system becomes your colleague, it gives you direction, and you follow it. If you grasp this discipline, even market uncertainty won't shake you. Systematic trading isn't a miracle. It's a behavioral discipline that grows by being repeated daily. The biggest mistake in trading is believing that once you've built a system, you'll always win. The truth is, the market is never the same. It changes in its movements, its trends, and its speed. And if your system doesn't change, it will gradually become irrelevant. Therefore, it's essential to evaluate, adapt, and refine your system periodically. This process sounds technical, but in reality, it's as much mental and behavioral as it is technical. First, let's talk about evaluation. Every professional trader does one thing: they write a diary. Their trading journal is their most trusted companion. Every trade, whether a win or a loss, is noted. And not just entry, exit and profit, but also the mental state at the time, the reasons, adherence to rules, and the emotion of taking the trade. Why? Because to improve the system, you don't just need data, you need behavioral data. You're not just looking at where you lost money, you're looking at where you deviated from the system in your thinking. Now comes the second stage: adaptation. Every system is designed for a specific market. Some systems do well in trending markets, some in sideways markets. But when the market's mood changes, the system's performance changes. For example, if your system focuses on breakouts and the market is consistently trading in a range, you might experience continuous stop losses. At this point, a trader needs to understand: is my performance declining because I'm breaking rules, or because my system isn't suited to the current market? This requires great discernment. Many times, we panic when performance drops and start changing systems, when in reality, just a little patience can bring the market back in line with the system. So before changing your system, ask yourself 3 questions. Did I follow the rules precisely? Has the market's behavior truly changed? Can a small adjustment make the system favorable? Now let's talk about refining the system. Refining means gradually improving the system. Here are some practical methods professional traders use. First, adding filters. If your system gives too many false signals, you can add an additional condition like volume or RSI support. Second, reviewing the time frame. Sometimes a system doesn't work in one time frame but performs very well in a slightly higher or lower time frame. Third, adjusting position sizing. System performance doesn't just depend on entry and exit. It also depends on your position sizing. Are you taking too large positions? Are you taking too many trades at once? Sometimes we try to make the system so perfect that it doesn't work in the real market. This is called curve fitting. The way to avoid this is to keep the system simple and robust. Now let's talk about another important practical aspect: biases. The biggest danger when analyzing a trading system is our own thinking. For example, if we believe the market will always go up, we'll give more importance to those trades in the system that were successful on the long side. So before evaluating a system, understand one thing. You need to step back and observe yourself. You need to look at data as data, without mixing in your own thoughts or desires. For this, some traders take help from others, like trading communities, mentors, or data analysts, so they can get feedback. Now, let's talk about feedback loops in the system. This is a scientific principle that's present in every successful system. It means the system improves itself by learning from its past outputs. How can this happen? Suppose your system has shown 20% more drawdown in the last 50 trades. Now you ask, why? Is the stop loss too far? Is the timing of the trades wrong? Is the volume condition being missed? You gather all these observations in a document. And then, after every 50 or 100 trades, you review it. Through this process, your system transforms from a normal tool into a living system that improves over time. Now, some practical tips that every systematic trader should adopt. First, no trade is also a good trade. Just because your system is quiet, don't panic and make manual trades. Silence is also a decision. Second, don't fall in love with your system. If a system isn't working and the data clearly shows it, don't be afraid to change it. Make decisions based on logic, not personal emotion. Third, don't make the system seasonal. Some people believe the market goes up during Diwali or that there's a rally before the budget. But unless these things are proven by data in the system, don't include them in your system. Fourth, diversification within systems. If you have more than one system, like a breakout and a mean reversion, learn to balance the signals of both. Sometimes one system is failing while another is working, and this diversification keeps your equity smooth. And finally, make the system a lifestyle. Just as an athlete practices every day, a musician rehearses every day, a trader has to live with the system every day. This is a discipline, a dedication. Here, you learn to operate not by your emotions, but by your system. And that's the subtle difference that turns an amateur into a master trader. Chapter 7, Part 2. The biggest deception in trading is that we think if our system becomes perfect, we'll never lose. The reality is that there's no such thing as a perfect system. Every system works within a specific framework, and that framework is always one step behind the market. The market is operating in the present, but every system is based on the past. Therefore, whenever a system doesn't work, the fault isn't with the market. It's not with the system, but with the trader, who doesn't know how to use it in a changing context. Now the question arises, what does a mature trader do when their system starts to fail? First, they don't panic. This is the biggest mistake most new traders make. As soon as a few trades go bad, they get scared. Did the system give the right signal? Did the trader take it at the right time? Were there external market factors affecting it? Can the system be adjusted slightly? This data-driven thinking makes a weak trader strong. Now let's talk about another important topic, resilience, which is the ability to stick with trading. Many traders drop out simply because they didn't show patience in testing their system. They saw losses in just 10 to 20 trades and thought, this doesn't work. But the reality is that no system is proven until you fully trust it for at least 100 to 200 trades. A behavioral factor is at play here. We consider our losses more seriously and quickly forget our wins. Therefore, when evaluating a system, you need to rely on numbers, not just your feelings. Now let's talk about a very underestimated aspect, risk of ruin. This means, does your trading system have enough stability that it won't wipe out your entire capital during a bad period? Suppose your system works with a 40% win ratio and gives a 1:2 reward to risk. Even then, if you made wrong entries 8 out of 10 times and your risk per trade was too high, your equity could go down very quickly. Therefore, mature traders always monitor their system's risk metrics. Some key metrics are maximum drawdown, how big of a loss you've seen in a series, average losing streak, how many consecutive trades you've had losses in, risk per trade, are you taking more than 1% risk? All these things should be part of the system. Your system should not just be an entry-exit chart, but a capital protection framework. Now the question is, can the same system work in every phase? The answer is no. A trader needs to be able to identify the market phase along with the system. There are 3 general market phases: trending phase, where the price continuously moves in one direction. Momentum systems work here. 2. Ranging phase, when the price moves up and down within a limited range, like on budget day or during an RBI announcement. Neutral or no trade systems work here. Therefore, some mature traders adopt a multi-system strategy. They run 3 systems simultaneously, but allocate each system based on market conditions. For example, if the market is trending, they conduct 60% of their trades with the trend system and leave the remaining 40% for ranging and neutral systems. This becomes a type of portfolio management of systems. Now, let's talk about discipline versus flexibility. A trader needs to adopt 2 opposing qualities simultaneously. 1. A mature trader knows that their job isn't to be a slave to the system, but to constantly improve the system while aligning with the market. Now, one last important point, mental energy management. Operating any system requires mental energy. If your system is too complex, giving too many indicators, too many signals, you can fall victim to decision fatigue. Mature traders always rely on simple systems because they know that overthinking doesn't improve trading, clear thinking and less confusion do. Therefore, the more your system runs on automated logic and the less on emotional judgment, the better. And when you reach this level, where the system becomes a simple routine, where you follow it without thinking, then you become not just a trader, but a professional. This is where the true art of trading begins, where winning or losing are no longer just numbers, but small steps towards a bigger vision. Chapter 8, Part 1. No matter how good a trading system you follow, if your mindset isn't clear, every decision will be blurred. The real battle of trading takes place within your mind. People think trading is about beating the market, but in reality, it's about understanding and playing with yourself. If you conquer your emotions, every market move will be clear to you. We start this chapter with a bitter truth, fear of missing out, or FOMO. FOMO is the emotion that drives even the calmest trader crazy. When you see a chart and feel that if you don't enter now you'll miss the opportunity, that's where a wrong trade begins. In reality, FOMO stems from a deep place where we don't believe that the next good opportunity will come again. We think the market will give one chance and never another. But a true trader knows that opportunities are infinite, but capital is not. So whenever FOMO arises, ask yourself, am I entering this trade with logic or just out of fear? FOMO's other sister is overtrading. This is a situation where a trader repeatedly trades simply because they feel like if they don't do something, they'll fall behind. But professional traders always understand one thing. Silence is a strategy. Not trading in the market is also a trade. It's not necessary to trade every day, but it's necessary to learn every day. Now, let's talk about hope and desperation. When a trade starts going against us, new traders often think, let's wait a little longer, maybe it will come back. This is hope trading, where we trade based on hope, not logic. But professional traders never hope. They either cut or flip. Hope doesn't blind them, because they know the market doesn't care what you thought. Now, let's move on to another deep psychological pattern. Confirmation bias. Whenever we're interested in a particular setup, we automatically start seeing things that support our thinking. For example, if you've decided that the market is going to fall, you'll consider every small resistance as confirmation. You won't be able to see that there might be a breakout or a strong demand zone forming. Therefore, before every decision, a professional trader asks themselves a question. Is this setup coming from the chart or from my assumption? If the answer is assumption, that trade is cancelled. Now let's talk about emotional anchoring. This is the state when you've taken a trade at a certain price and now your mind is stuck on that price. Suppose you took a long trade at 1850. Now when the price has fallen to 1820, you keep imagining a return to 1850. But the market doesn't care where you entered. The market will only move according to demand and supply. If you've tied that entry point in your mind like an anchor, your thinking will be limited. Therefore, professional traders view every new candle as new information. They detach the previous entry point from their minds. Now let's talk about revenge trading. Suppose you suffered a big loss, and now you feel internally that you need to get that money back right away. This is where the most dangerous trading behavior begins. You don't look at logic, you don't look at the setup, you just think, do anything, I need my money back. This mindset leads you to deeper losses. Therefore, professional traders separate themselves from the screen after every loss. They ask themselves, am I still objective? If the answer is no, they take a break from trading, because they know that mental clarity is more profitable than any setup. Now let's talk about comparison syndrome. Someone posts on social media 5 lakh profit today, and you think, I only made 5,000. This is where self-doubt, dissatisfaction, and haste begin. But you have to understand this. Every trader has a different capital, risk appetite, experience, and journey. Don't change your strategy by looking at someone else's life. Don't lose your direction by looking at someone else's speed. Professional traders never compare. They try to be better than their previous day, every day. And now let's talk about the most overlooked aspect, mental fatigue. Trading isn't just a screen job. It constantly demands decisions from your mind. Every candle, every move, every price action continuously tires your mind. If you don't take a break, your thinking starts to dull. Therefore, experienced traders always do 2 things. They have pre-decided trading hours. After a certain time, the screen is off. 2. They prioritize offline activities. Walks, music, family, journaling. Because they know that a fatigued brain cannot read a fresh chart. Trading success doesn't just come from strategy, but from clarity, balance, and self-control. You've built a system. That's great. Now the question is, can you follow that system even when your emotions object? Because in the end, it's not the market, it's your system. You've built your system. Chapter 8, Part 2. When you step into the world of trading, your biggest enemy is your own mind. This mind can deceive you many times because it's full of emotions, fear, greed, and expectations. So the question is, how do you remain the master of your mind so that your trading is filled with insight and discipline? First, let's talk about the mental framework. Trading is not just about price fluctuations, it's a way of thinking, a structure under which you understand every market movement. Behind every successful trader is a strong mental framework that includes these things: acknowledging your mistakes, a continuous desire to learn, self-confidence and patience, a legal understanding of risk management, controlling emotions. The most important of these is believing in your trading plan. Once you've set your rules, learn to follow them without any doubt. The second important aspect is emotional regulation. In the market, your emotions are so intense that they directly affect your decisions. Fear and greed can overpower your mind. Fear compels you to sell quickly, while greed incites you to invest more without thinking. Both are poisonous for trading. Therefore, it's essential to keep your emotions under control. For this, saving money is as important as earning it. This means you should never put your entire capital into a single trade. And for every trade, decide how much loss you can tolerate and set your stop loss accordingly. Here's one thing: every trader loses in the market. The only difference is how successful traders handle losses. They know that loss is a process, and they protect their capital to find a better opportunity next time. The fourth point is using a trading journal. Keep a record of every trade, why you did it, how you did it, what you learned. This habit helps improve your trading. You learn from your mistakes and repeat your good decisions. The next important aspect is discipline. This is the quality that helps you follow your rules and protects you from the emotional storms of the market. Without discipline, trading cannot be successful. Here are some tips to maintain discipline. Dedicate time for trading every day. Don't deviate from your trading plan. When there's uncertainty in the market, take a break from trading. Celebrate small wins and consider big losses natural. Additionally, mindfulness and focus are also important. Lack of concentration can make you miss market signals. Therefore, it's important to meditate, calm your mind, and be fully present during trading. There's a lot of noise in the market. Different news, rumors, social media trends. Don't be influenced by all of this and trust your own research and analysis. Now let's talk about adaptability. The market is never static. New rules, technology, global events constantly bring changes. Therefore, a successful trader is one who can update their strategy according to the changing environment. Often, new traders cling to old strategies, but those who adapt themselves to the market win. Along with this, patience is also a great virtue in trading. The desire to make quick profits can force you to make hasty and wrong decisions. Wait for the right market timing. Big opportunities often come with patience. Finally, you need to understand that trading is a continuous journey, not an end. Every day, every trade brings a new lesson. A trader should always have a desire to learn. This book teaches you how to become the master of your trading story, not its victim. How to transform your mind into a skilled and disciplined tool that can remain stable even amidst market fluctuations. If you adopt this mindset, not only will your trading life be successful, but you will also become personally stronger. Chapter 9, Part 1. The market changes. Those who can remain stable amidst market fluctuations will not only have a successful trading life, but your trading life will be successful. Then not only will your trading life be successful, but your trading life be successful. Then not only will your trading life be successful. Then not only will your trading life be successful. Then not only will your trading life be successful. Then not only will your trading life be